How can you forecast the future of your investment looking at the yield curves? Hello, how are you? This is Priyanshi and I welcome you all to our knowledge series by Smesh Discover, where you can get smart about investing. What if I say that you can guesstimate the future course of the interest rate in the bond market? You must be thinking, what? How? Let's begin with a simple definition. A yield curve is a line that plots yield, that is, interest rates of bonds having equal credit quality but different maturity dates. The slope of the yield curve gives an idea of future interest rate changes and economic activity for the maturity period, which can range from 3 months to 30 years. Steeper curves depict big changes while flat curves depict no change at all. Let us look at the curves one by one. Number 1, normal yield curve. As you can see, it is an upward sloping yield curve. A normal yield curve shows that longer maturity bonds offer higher yield as compared to shorter maturity bonds. The yield curve is positive or upward sloping because investors demand higher yield for locking up their money for a longer period. An upward sloping yield curve also signals economic expansion and implies the bond market expects the economy to do well. Number 2, inverted yield curve. It is a downward sloping yield curve which indicates that yields for bonds with shorter maturity are higher than that of long term. Here, investors project that long-term yields will be lower in future. Lower returns lead to a decrease in investments that is associated with economic stagnation and deflation and also implies that bond market expects the economy to do badly. Number 3, flat yield curve. Typically, the curve flattens when there is transition period between the normal yield curve and the inverted yield curve. Number 4, steep yield curve. A steep curve depicts that long-term yields are rising at a faster rate than short-term yields. This type of curve has historically indicated the beginning of an expansionary economic phase. The main distinction is that a steeper curve shows a great spread between expected returns over the short and long terms. Number 5, hump yield curve. In this type of curve, there is a small bump in the middle. This type of curve is rare and indicates the slowing of economic growth. Now, you must be thinking, why is it important to consider the yield curves? Let's see what analyzing the yield curve can help you with. The curve can help to forecast the future course of interest rates. For example, if the curve slopes upwards, the interest rates are expected to go up. This indicates that bond prices will fall and investors will look for short-term bonds or other securities that are not sensitive to the interest rate changes. And the opposite will happen if the curve slopes downwards. The curve can help the financial intermediaries to ascertain this spread between borrowing and lending rates. For example, if the bond yield curve indicates that an economic slowdown might be on the horizon, investors might move their money into defensive assets that traditionally do well during recessionary times. Yield curve also helps the investors arrive at the investing decisions in terms of maturity. Generally, in equilibrium, the yields of similar risk securities at different maturity levels will be on the yield curve. If a bond is above the curve, it is underpriced, indicating a buy signal. Alternatively, if the bond is below the yield curve, it is overpriced and investors will sell it till the prices go down and the yield increases. There are certain factors that affect the yield curve. Let's see one by one what they are. Number 1 is monetary policy. The actions of RBI can have a significant impact on the yield curve. For example, if RBI raises interest rates to control inflation, it may cause short-term bond yields to rise faster than long-term yields, resulting in a flatter yield curve. Number 2 is economic growth and inflation. The yield curve is also impacted by the expectations for economic growth and inflation. For example, if investors expect strong economic growth and higher inflation in the future, they may demand higher yields on long-term bonds, resulting in a steeper yield curve. Number 3 is supply and demand. The supply and demand factors can also influence bond yields and the shape of the yield curve. For example, if there is a high demand for long-term bonds, their yields may be lower than short-term bonds, resulting in a flatter or inverted yield curve. Number 4 is the investor sentiment. Many times the sentiment and the risk appetite of investors can also impact the yield curve. For example, during times of economic uncertainty or market volatility, investors may demand higher yields on shorter term bonds, resulting in a steeper yield curve. Number 5 is the credit risk. The creditworthiness of the issuer can also impact the yield curve. For example, the bonds issued by entities with higher credit risks, such as lower rated corporations or countries, may have higher yields than bonds issued by entities with lower credit risks, resulting in a steeper yield curve. Well, did you see how the yield curve and its understanding is important for investors like you now? That was all for today, and I hope today's video did bring you a step closer to being smart about investing. Visit smest.in and take the next step towards investing wisely. Stay tuned for more exciting lessons coming your way. But before signing off, always remember investments in debt securities are subject to market risks. Read all the offer related documents carefully. For any queries on this module, please leave a comment below. See you in the next video.